Imagine someone hands you 100,000 ringgit and just says, invest it. What would you do? Well, today, we're going to break down a real-life case study where that exact thing happened. We're taking a university investment report and turning it into a practical guide, showing you how a winning strategy was built from scratch. Let's dive in. So, let's put you in the driver's seat. You've got 100,000 ringgit in virtual cash. Where do you even begin? That's the exact challenge a team of finance students faced, and their journey gives us this incredible playbook for how to navigate the markets. So here's how we're going to walk through their story. First, we'll look at the mission. What were their goals? Then, how they built their master plan. After that, we'll get into the details of their trading playbook, see what tools they use to pick stocks, and finally, we'll check out the results, the profits, the losses, and the most important lessons they learned along the way. All right, first things first, you can't start a journey without knowing where you're going, right? So before they even thought about buying a single stock, the team had to define what success would actually look like. And here's the setup: 100,000 ringgit in virtual money. The challenge? Invest it over a single semester. It sounds simple, but, it's also a pretty daunting task. Now, this is what I find so smart about their approach. It wasn't just about making money. Sure, growing the capital was on the list, but their real mission was to get their hands dirty, to gain real-world experience, to actually understand how the Bursa Malaysia works, and to finally connect all that classroom theory to what happens in practice. Okay, so with that mission locked in, it was time to build the master plan. This wasn't about guesswork or chasing hot tips. This was about creating a solid set of rules to guide every decision and, the most important part, to manage their risk. And the bedrock of their whole strategy was this one big idea: diversification. It's the classic advice, right? Don't put all your eggs in one basket. By spreading their money across a bunch of different investments, they were building a safety net just in case one of their picks went south. And they didn't just talk about it, they turned it into a strict rule book. For starters, no single stock could take up more than 20% of their money, and they had to own at least 10 different companies. Simple. Then they added other layers of safety. They stuck to Sharia-compliant stocks, and they stayed away from those super risky penny stocks, only touching ones priced above 50 cents. And finally, they made a rule to do at least 20 trades, which forced them to stay engaged and learn from their actions. This was all about discipline, not luck. So, they've got this awesome master plan, but how does that translate into actually clicking the buy and sell buttons? Well, that brings us to their trading playbook, the real nitty-gritty tactics for how they got in and out of their trades. Now, pay attention, because this might be the most important rule they had: their cut-loss strategy. They decided before they even bought a stock that if it fell by 3 to 7%, they would sell it. Period. No second guessing, no hoping it would magically bounce back. This is so crucial because it takes all the emotion out of the equation. It's what stops a small, manageable loss from turning into a total disaster. Their plan for buying stocks was just beautifully simple. Step 1, only look for stocks that were already heading in the right direction, stocks in a clear uptrend. Step 2, set a realistic goal for each trade, aiming to make somewhere between 5 and 15% profit. No swinging for the fences, just consistent, achievable targets. And their exit plan? Seriously clever. They used a strategy called scaling out. So when a stock hit their profit target, they didn't just sell everything. Instead, they sold half. This locked in their gains and got their initial investment back. But then they let the other half ride, just in case the stock kept climbing. It's a fantastic way to balance taking profits while still leaving room for a bigger win. So they had a rock-solid plan for how to trade, but that's only half the story, right? The big question is, how did they decide what to buy in the first place? Well, they used a powerful 1-2 punch of 2 different types of analysis to get the full picture. And this breaks it down perfectly. First, you have fundamental analysis. This is like being a detective, digging into a company's health and finances to answer the question, what should I buy? Is this a good, solid company? Then you have technical analysis, which is all about looking at charts and trends to answer the question, when should I buy? It's about timing. And here's what that fundamental analysis looks like in the real world. You can see the different flavors of companies right away. Look at Nestlé. That return on equity is massive. It's an incredibly efficient profit-making machine. But its PE ratio is also sky high, which tells you its stock is pretty expensive. Everyone knows it's great. Then you look at Gas Malaysia. It has a very healthy ROE, a much more down-to-earth PE, and a really nice dividend. It's more of a steady, income-focused choice. So after checking the company's health, they looked at the charts. And this is where it all came together. Nestlé's chart showed a beautiful, healthy uptrend. That was a big green light. But Gas Malaysia? Even though the fundamentals looked decent, the chart was telling a totally different story. It was in a downtrend. Sellers were in charge. This was a huge red flag. It's the perfect example of how a good company isn't always a good buy right now. All right, the moment of truth. After all the planning, all the analysis, all the disciplined buying and selling, how did they do? Let's get to the final results and, more importantly, the incredible lessons they learned. And there it is. At the end of the semester, they finished up with a profit of 995 ringgit and 50 cents. It's not a lottery win, but it's proof. They successfully grew their capital, showing that their methodical, disciplined approach actually worked. But hang on, this is the most mind-blowing part of the whole story. Look at that chart. Their win rate was only 40%. Let that sink in. 60% of their trades lost money. So how in the world did they end up making a profit? And that right there is the golden nugget. This is the secret sauce. Their success didn't come from having a crystal ball and being right all the time. Not even close. It came from being absolutely ruthless with their rules. Their cut-loss strategy meant their losing trades were just small paper cuts, while their exit plan let their winners run and become big wins. They simply made more on their winners than they lost on all those losers combined. And you know what? They knew it too. In their own trading journal, they wrote that the biggest challenge wasn't picking the right stock, it was controlling their own emotions, fear and greed. Having those rules in place beforehand was what kept them from making bad, emotional decisions in the heat of the moment. It really shows you that the biggest battle in investing is usually the one happening in your own head. So I'll leave you with this to chew on. This team was wrong more often than they were right, and they still came out ahead. What does that really teach us about the secret to investing? Maybe, just maybe, it's not about the impossible quest to find more winners. Maybe the real secret is just getting really, really good at handling your losers.